and thanks for joining us for episode 2 of our transition series. In today's episode, we'll be discussing how to find the leases you don't already know about and how to classify your leases as operating or finance. With me today is Sarah O'Sullivan, Director of Product at Lease Query. Hey, Sarah.
Hey, Emily.
So in our previous episode, we talked about how to know if you have a lease. So now, and in theory, you know about those leases, right? Because you either have been paying for them or, you have some sort of centralized process that, you are notified when your company has entered a contract. But sometimes things are not centralized and you have different teams out there entering contracts for your organization, and you may not know about all of them. So in that scenario, how do I find them? Where do I look?
Yeah, and it's a great question, and it's a really critical step of adopting ASC 842 and being successful with compliance. And, like you said, we know what a lease is, and we've been accounting for leases previously, but now we need to make sure we're identifying all of them and finding them, because it's got a direct balance sheet impact now, because we're putting a liability and an asset on the balance sheet for these operating leases. And public companies that have already adopted, they're often going to tell you that one of the most challenging parts of this process was just the logistics of really finding these leases, getting the contracts, and pulling out of them all the data that you need to measure those liabilities and assets. I know for my own experience, it was definitely more challenging than what I anticipated going into it, just kind of getting my hands around all of this data. And so that's one of the reasons why it was a good idea to talk today about some of these best practices. And so I think one of the first things to take a step back and think about when you're starting this is to realize you as an accounting department, it's going to take time. It requires time. And it requires collaboration with other departments. I mean, typically, most accounting departments, they don't have all the contracts right at their fingertips. So you're going to rely on the assistance of, other departments. You're going to go to, for example, procurement and legal, supply chain, your AP, treasury, as a couple of examples of who you want to go talk to ask them for help in help me locate these contracts, pull all this information, and then we can look at it all and kind of regroup and figure out which ones are in scope that we need to include under ASC 842. So I would just say one of the first steps to this is identifying those other departments you're going to need to talk to, who you're going to rely on, and also identify who your point of contact is going to be there. Somebody that, is really a solid standard person that you can talk to over and over, because you're going to have some follow-up questions too as you're going through this. But then more into the details of what are some actual steps you can take to go find these leases, in addition to, this overall idea. And I think the first thing most companies do, I know we did, was to just really dig into your rent expense accounts and into your general ledger. That's going to be where your history of everything that's been a lease that I've recorded is. And so that is going to be a good starting point for going to find what leases that you need to put onto your balance sheet. And included in that would be, you're looking for recurring payments. That's a good, very good first step. Operating leases, they typically are going to have the same payment for a period of time. You're going to be paying it monthly. So if you're looking at your ledger and your rent expense accounts and you're seeing the same amounts popping up every month, every period, that's a pretty good indication that you've got a lease there that you need to go find. And in addition to looking at the expense accounts themselves, go talk to your AP team. I mean, this is the team that's making these payments. A lot of times with these recurring payments, they're sometimes scheduling these payments in advance as well. So they're telling the system or themselves this is coming. And so I would say, go ask them, can I have a list of all the recurring payments that you're making? And then go one by one down that list and say, this one is a lease, this one is a recurring payment, but it's not actually a lease. It's another, business transaction that we have in our business. And so I don't need that one. And not only is that going to help you really find a big chunk of these leases and help you get it, but it's also going to give you a good way to document what you've done and be able to provide that to your auditors as evidence that you have done this process and that you have found a complete listing. And so other than that, I think kind of another way that you can approach this is, again, as an accountant, you're not going to have all the details of all the business transactions. I mean, you know the accounting, but you don't always know the nature of these arrangements and what's going on behind the scenes. So go to your operations teams and your purchasing teams and treasury teams and ask those questions, not just say, hand me all your leases, but like we've mentioned before with embedded leases, they don't always say lease on the contract. So you want to ask questions like, tell me about your transactions. What are the assets that we're using in our business and our operations? Let me get more to the details of the arrangement and find out, okay, it doesn't say that we leased it, but potentially we need to look at this contract because maybe we have an embedded lease here. And so again, it's really crucial to find all of those leases. And you as an accounting team, you're not going to find them all on your own. So you need to have the buy-in from these other departments and really partner up with these other people that are going to help you do that. So you pulled all of this together, all these different steps to kind of get all this information together. And you're going to want to perform some sort of reconciliation or other exercise that is going to be able to confirm for you that you found everything, that you got a materially complete listing. And also you want to be able to prove that to your auditors as well. So you want something that you can document and you can show them. And the most basic way to do this, go back to those rent expense, the general ledger that you've gotten familiar with at this point. Take your new listing that you've compiled, pull from it based on the leases that I have listed here. I would expect my payments to be X and my expense to be, X, and compare that to what you've been recording in prior periods. If it's pretty consistent, then you're probably looking pretty good. But if you've got discrepancies or gaps, you've been recording more in the ledger than what you have on your listing, it's probably a good sign that you're missing some leases off of your listing. So you got a little bit more follow-up work that you need to do to go find those. And then another reconciliation kind of exercise you can do is leverage that contractual obligations disclosures that we as companies have been putting in our MD&A in the past. You've already done a lot of work in the prior year to pull that information together, and you've told your financial statement users, this is what we expect as a company to pay for our operating leases for the next 5 years or so. Well, use that similar to looking at the GL detail. Did the list of leases that you compiled, does it seem to correlate with that same number? Are you finding that you're expecting, the same number of payments that you've said in the past you're going to pay? If there's big differences, then again, you might be missing something. There might be somewhere else that you need to go look.
Now, those are great approaches. And, I know in my experience, we use both of those. I met with leaders throughout the organization to talk about assets they were using to determine if they were leases. And then I did I scrubbed our GL from top to bottom, looking for recurring payments and any sort of frequency to indicate that there may be a lease involved. And I know in my review, we didn't really find any additional leases, but we had a pretty tight, contract process. So let me ask you, Sarah, did you find many leases that you didn't know about in your review?
Yeah, so I would say we definitely had, not some big surprises, but we definitely were finding some leases that I don't think we were thinking of going in. And part of the reason why I mentioned really briefly before is, we had to look outside of our rent expense accounts. So we've got dedicated rent expense accounts, but in reality, you're going over years of a company and recording in your ledger, new accounts are popping up, somebody's using something differently. It's just, you need to be aware of the fact that the rent expense accounts might not have it all. You might have had some leases that creeped out to other parts of your chart of accounts in your ledger. And so that was one way that we found some things that you start seeing these periodic recurring payments somewhere else, and you start looking into it and find out, yeah, it's a lease. And it wasn't just at adoption. I'd also say, keep it up and keep reconciling and looking for a period of time after you've adopted, because we even were finding, in the few months after we initially adopted, we were finding some things. We continue to find things. And so at some point you're going to have that full list, but yes, it's an ongoing process.
Yeah, that's true. The ongoing process part, because the rest of your business didn't change just because you have new accounting rules, right? Like departments outside of accounting aren't going to really change their process just because you have some new way to account for things. So now that we've identified all of our leases and we have our arms around our complete population, we have to put them in buckets, right, on our balance sheet. We have our operating leases and our finance leases. So how do we determine which bucket to put our lease in?
Yep. And you're exactly right, Emily. That's another really crucial step, is that it's not just that all the leases are coming onto the balance sheet now. We still have these classifications of operating lease and finance lease, and they have separate presentation and disclosure requirements. So you can't intermingle them all. So it is important that you get them bucketed into the right categories. And so the classification that you want to do, the criteria that you need to review and analyze when you're looking at your leases to determine which category it belongs in, there weren't significant changes for the most part in ASC 842. So we're used to them. We've been doing this for a long time. We've been going through these criteria. So we don't necessarily will go through each step and each criteria in detail, but there are a couple of things to highlight that are new concepts in ASC 842. And the first one is the bright line thresholds that we're used to when we're looking at the classification criteria. Those have been removed. And that's, it's now using terms like substantially all, and that is allowing more room for judgment on the part of companies when they're trying to analyze and bucket these into categories. And so, for example, what I'm talking about is we're used to some thresholds of how much does represent the amount of payments that we're going to pay over a lease term compared to the fair value of that underlying asset, or how do I compare the lease contract term to the economic life of the asset that I'm leasing?
Right.
So instead of having, these specific numbers to hit, now it's this
75 and 90.
Yep. And what we're really finding, there's room for judgment here now, but I know, I know our own experience as well as what we've seen from customers is that in reality, most people are holding on to those thresholds still using the 75 and the 90. They're really good proxies for what substantially all seems to mean. And so it's a good basis. But the other thing that is like a real true change is that ASC 842 does add an additional criteria into the analysis. And this new criteria is about specialized use. And so what this criteria says is if you are leasing an asset and it is so specialized in nature that essentially there's no residual value to the lessor when that asset gets returned to them at the end, they don't have any more value or life because they've, an example is they have constructed a new piece of equipment for you that's to your specifications, it's retrofitted to your location and your business, and it's not really usable outside of your use for it. If you're in that situation, then you're going to classify it as a finance lease rather than an operating lease. So that is a big change. That's something new that we all need to think through now.
So like if I have a piece of machinery and it has one special widget that only fits this other special widget that I'm already using, and then I return that piece of equipment to the lessor and they cannot turn around and release that to someone else. That's what would qualify as that specialized use and fall under the finance umbrella.
Yeah, that's right, because it doesn't matter so much that you're returning it and the ownership isn't really transferring. The substance of the fact is that you're using that asset for its purpose, and it doesn't have a purpose beyond you.
Great. Well, thanks so much, Sarah. And to our audience, we hope you found today's episode helpful. As a reminder, we have many other episodes in this transition series to help you simplify complex accounting. In our next episode, we'll discuss the accounting assumptions and elections you'll have to make during your transition.